if you're willing, just go ahead and click willing to record, and we'll get this started. So first off, I want to thank William and Ekenna for coming out here today. I'd like to thank Lydia and Mike, who couldn't be here right now, for letting us John, for allowing us to get this set up. But I just wanted to get BEC back on the board and kind of get some activities going for this month. And so we have two investment. I would call them two gentlemen from an investment firm located here in the Bay Area, but operate a little over the nation, and have worked with many different companies and worked with many different. Sorry, I am sharing the wrong screen. There you go. Yes, and have worked with many different people from all around. They are big into community service. They've done. That's kind of how I got introduced to them. I've known them for about 8 months now, and I've gotten to know them personally. I don't know, even though it's through COVID. I just want to again thank them for coming out, and I hope that today they're putting on a great event. I'll give you a little background about them. Let's start here. So William, who's wearing the ball cap right there, he's the founder and CEO of Bay Street Capital Holdings. This year he's recognized as the #1 financial advisor in the Bay Area, and he's recognized by as one of the top 100 financial advisors in the U.S. by Investopedia. He's an accredited investment fiduciary, and tomorrow will be accredited investment fiduciary analyst, the highest designation in the retirement and fiduciary space. Ekenna is a certified financial planner, and there are only 1,500 African-American CFPs in the country, so certified financial planners. And he's the CFO and director of planning at Bay Street. He was recognized as a top financial advisor in Arizona, and is one of the top 100 advisors focused on diversity, equity, and inclusion. He double majored in finance, economics, and behavioral science. And as a firm, Bay Street was ranked second place for Asset Manager of the Year out of 900 firms in the category of corporate social responsibility. And so with that, I'd like to turn the board over to them. And if you guys are ready to share your screen and let you guys take it away. Thanks for coming.
Thanks for the introduction, bro. And again, thanks everyone for popping on. I really appreciate Stefan putting this together. It's rare that you have someone who's actually looking to help us as a community share knowledge. When I started Bay Street, I did it because there weren't a lot of Black-owned asset managers in the institutional space. There's a lot of Black advisors that are providing wealth management to families, but there weren't very many that were providing services to the organizations like a Lockheed, right? Like a Northrop, et cetera, et cetera. And what that leads to is a lack of diversity across the options employees receive in their 401ks, right? So for example, if you were to log into your 401k, as much as all these organizations speak about DEI, what you'll see is that you don't have any representation across the spectrum in the funds that you're selecting from. They're all primarily going to be white male-owned investment funds. And so what Bay Street does is we advocate for diverse and emerging fund managers. These are Black-owned firms, women-owned firms that are top quartile, meaning they're top performers in their sector, in their category where they're investing. And we show organizations why it's important for them to include them in that lineup that you, the employees, get to select from. A lot of our work is also around financial literacy. That's what we're doing today. So we're going to speak not just general finance, we're also going to touch on some things that you might never have heard of before. Even though you're at Lockheed now and you've not ever received an equity award, or say you were at a company where you had ISOs or NSOs or RSUs, terms like this are typically not they're not shared at a dinner table in the Black household. So we want to make sure that you leave this workshop with the confidence necessary that as you're negotiating, as you're going through your career, if you hear these terms, if you're forced to make it, or if you're in a position where you're making a decision around what should you do, you've got some level of awareness. You've got an organization that you can reach out to and ask questions who's familiar with your circumstance and situation, and also culturally who will understand where you've come from in terms of background, being an African-American in the workplace. Again, I've got Ekenna with me. He is my business partner. He's my partner in crime. I'm super excited that he was able to join us today because a lot of his work before joining Bay Street, he was one of the top advisors at Charles Schwab. He was one of the top 1% at TD Ameritrade. He actually managed some of my personal money at TD Ameritrade. And when I first met him, I said, man, one day I'm gonna see if I can get that guy to come to Bay Street. And sure enough, when Schwab bought TD, I reached back out. We started that conversation. And what I didn't know about Ekenna at the time, I didn't know much about his background or his school or his education. But what I came to find out after doing these workshops together is he actually managed a lot of equity awards for several of the tech companies in the Bay. So he actually came with the subject matter expertise that wasn't my background, it wasn't my skill set. And so together, we're really thankful that we're able to kind of provide this full court press when it comes to holistically, not just putting together a plan for the family, but also understanding each of those intricacies and areas that most folks don't talk about. So with that, let's get into this. First thing we're going to do is we're going to speak about RSUs and options. I know, again, that at Lockheed, this isn't a situation that you're currently in, but again, I want to make sure that everyone here from the beginning, if you've either received those or if you're looking at opportunities in the future, we want to know what these are, because this is how a lot of tech and highly compensated employees are making their wealth. It's not just from your base salary, it's from the equity awards that companies are offering. And oftentimes, diverse employees, Black employees, women employees, they're receiving less equity awards. They're negotiating for less equity awards. And they're also not sure what to do when they receive those equity awards. They don't know if they should purchase the stock options. They don't know if they should exercise or sell the stock options. So we want to start here because it's a critical piece to the investment timeline while everyone on this call is in their career. Ekenna, let's get it going.
Yeah, absolutely. And sorry about that. I live actually pretty close to a fire station, so hopefully that's the last call that they have for today. But yes, my name is Ekenna Anya-Gafu, as they mentioned. I'm the director of planning. And I've actually put together the slides for this workshop, as well as the different workshops that we have for different diverse groups. And so, yeah, starting off, we do have the RSUs and the options. There's going to be a lot of three-letter words that we're going to be including over the next kind of few different slides and whatnot, but essentially an RSU is a restricted stock unit where it is a cash bonus. Easiest way to look at it, instead of giving you $10,000 cash, they say, hey, we're going to give you $10,000 worth of stock. And as mentioned, as William mentioned earlier, as we know, currently in the US, if you look at kind of what actually makes the most, like, quote unquote, wealth, real estate, long-term investments, RSU, and equity awards, right? And so we do believe that this is important, and this is something that we should understand. So RSU is a cash bonus, but instead of coming as cash, it's coming as stock. An option is actually giving the opportunity to buy the stock at a later date at a set price. Generally, that price is much, much lower than where the stock is trading. And so even after taxes, you should still be well ahead of where you were. And so options just a little different, that you actually have to put some cash down to buy them outright, where RSUs are just granted to you. And that's kind of that bonus / like opportunity or option to participate. All right. And by the way, if you have any questions at all today, please don't hesitate to reach out, in the chat or unmute yourself. We definitely want to make this as kind of interactive as possible. All right. Another set of three-letter words, essentially the NSO and ISO. The NSO being the non-qualified stock option. ISO is an incentive stock option. Really the big difference here, they're both options. They both give you the opportunity or the option to buy something at a later date at a set price. Biggest difference is the tax treatment of this, in my opinion, where an incentive stock option, essentially there's ways where you can really overall reduce your tax burden, right? If you just hold on to a certain extent, you actually will reduce your overall tax burden. NSOs are non-qualified stock options. That non-qualified kind of generally points that you're going to get some type of unfavorable tax situation. So with non-qualified, you get the stock, it's granted to you, and then when you exercise with the NSO, that's when you're taxed. With a ISO, there's something called an amortization tax or phantom tax, but it's not actually dollars that you owe sometimes. And so where NSO is every time. And so that's definitely I would say the biggest difference is really just the overall tax treatment and, kind of how you're going to be paying for them is the biggest differences there. And then also ISOs, because they're incentive, it's kind of incentive to stay at the company longer, can't necessarily transfer those, where NSOs, it's an incentive, but there's other things that allow you to get those, meaning that, you can transfer them outside of death. All right. Moving on. All right. Exercise choices. I think this is actually definitely important. What we'll notice is that often when people get these awards or, they're negotiating, they're just not sure what they are. And so trying to cover kind of different aspects of them. And essentially an exercise choice, you can either exercise early, where you say, hey, I'm going to vest later on. I have a strong belief that I'll still be with the company. You can pay that money early and exercise. Generally, there's a somewhat of a favorable tax situation that goes with early exercise because you haven't necessarily crossed it. And it's a weird kind of gray area of the IRS code where because you're exercising early, but you haven't actually received it, it's still unrealized. There's a lot of kind of questions of that. And so generally your tax situation is just better. You're going to hear me maybe overuse the word tax because I do believe that if you take the average person and just allow them to understand the tax code better, they would be in a much better situation as a whole. And so you're definitely going to hear me overuse that term, but it's just because of my fundamental beliefs that really a lack of understanding of investments, a lack of understanding of tax code puts people in bad positions. And so we're trying to kind of curb that now. And then the second thing that you can do, actually, there's technically three things you can do from an exercise standpoint. You can exercise early, you can exercise and hold. All that really means is that you're going to essentially say, hey, I'm going to buy the shares or buy the options, but you're not going to sell, trying to wait until you do get in that more positive tax situation. All right. And then the last one we have here is you can essentially sell. And easiest way to put this, once you finally exercise and you're ready to sell, you need that money, or you're ready to buy the house, or you've reached long-term capital gains, yeah, you're able to sell. And our biggest kind of recommendations around selling, definitely check your bias, right? Oftentimes when we look at people with equity awards, they really hold on to it, sometimes even to their detriment. And it's because, hey, your hands are actually part of the magic formula of why the company's going. And so people assume, hey, if I'm touching it, harder to fail. Not saying that would be the case. And Lockheed Martin has been here forever, it seems like. But just when you're getting these things, just something to be aware of. Check the holding period, aka making sure that you're getting to the long-term capital gains, especially in California. That saves you about 25, almost 30% from taxes. And then don't attempt to time the market using option strategies. It's just hard to time. Generally, by the time you say, hey, I want to sell, we've seen it time and time again, you may end up rolling yourself into like a blackout period. And so as a whole, try not to time the market, but more so when you need the money and based on the holdings. All right. All right. And then this actually just has to do with taxes as a whole. When we talk about investments, there's short-term gains and long-term gains. I think this is a big difference maker, right? So the kind of basic definition, long-term, you hold things over 365 days. Short-term, you're essentially holding it less than that. What's the difference in sell? I like to use very easy numbers. If you had $10 and you put $10 into a stock, that $10 grows to $20. Hopefully I'm not losing anyone. If you hold it over a year, you essentially, when you sell, that extra $10 of gains is taxed at a much, much more favorable rate. The average person gets taxed about 15% for their long-term capital gains. It can be as low as 0% or as high as 20%. Now you compare that same situation, you have $10 you put into a stock, that stock grows to 20, that would be great, right? 100% return. Now, if this is short-term gains, or let's say you sell before the 365th day, you essentially are locking yourself into short-term gains, which all that really means is that you wrote yourself a check or your employer wrote you a check didn't withhold any taxes, and it goes very much to your actual ordinary income. And so as a whole, if you can hold towards long-term gains is kind of the more favorite thing to do. But we always tell people, hey, we necessarily don't want the tax tail to wag the tax dog, meaning that, you know, if you're in a position, you're saying, hey, this position is going to definitely, you know, decrease, you know, times to sell. Hey, you know, you wrote it, you timed it right. You know, our goal is kind of that Warren Buffett philosophy of, you know, buy low, sell high, right? Very simple, but that's what makes the business work. And so if you've done that and you say, hey, now it's time to exit, even if it's after or before that 1 year, we say, hey, go ahead and do it, because at the same time, you know, much better to take profit than hold on to something because you're trying to get better taxes and end up worse off. All right. So I talked a lot in that 5 minutes, covered some, you know, kind of granular things. Any questions to this point? All right. All right. I'm going to move forward. And we do have a Q&A. So if you're not asking a question now, no worries. All right, moving forward.
For sure. All right, yeah, like Ekenna said, that's a lot of information to cover. Sometimes we spend the whole workshop on this because folks have a ton of questions. Sometimes we go through it, and then as we kind of open up for Q&A, feel free to ask some questions about it. We're definitely kind of comfortable to take it whichever direction makes most sense for everyone. Here, we're kind of now jumping into just general 101 planning, just setting goals, making sure that we understand the process that we should take. As you can see, we've illustrated this as a mountain. You know, first thing you want to do is get your debt under control. Next thing you want to do is put a budget in place. Ekenna works with a lot of households around something called financial journaling. It's not to determine how much are you spending on Starbucks or something like that. It's to get a clear sense of what is my net income coming in after taxes, what's my total expense, what are my current liabilities, and what's my total asset, and what are the goals that I have in place so that I can understand what is it that I need, what is it that I want as I'm working, and what is it that I'm wishing for, putting those buckets in place. And then also taking a look at the concerns I have. What are we concerned about? Is it aging parents? Is it raising children? Is it healthcare, et cetera, et cetera? So that as you're progressing through your career, through your work life, you can also be prepared to take care of any of those concerns as well, without being caught off guard, without having any sort of uncertainty around the future, because you put a plan in place to address that. Third thing, as you're growing your savings, again, the idea is to be able to invest with confidence. I tell a lot of investors, you have to have conviction when you're making an investment. If you have conviction, it's because you have a clear understanding of what you're investing in, right? So first and foremost, put that picture in place so that you understand your circumstance, that you understand where is that I'm today, what is it that I'm investing in, and why am I investing in this? So that when you have these market cycles, you're not making impulsive decisions. This is kind of interesting because this week, you know, Tesla was up 12% 2 days ago. Lockheed Martin was down 12% a day ago, right? If you're making these impulsive decisions, buying and selling things without conviction, without understanding the underlying asset, without understanding the goal behind why you're investing in the timeline, you will end up worse off, because impulsive investing does not work. Emotional investing does not work. You have to be able to say, okay, this is what I'm looking for. Here's my timeline, and this is the goal that I'm solving for. And when you do that, you can invest with conviction, so that you're not, as Ekenna was alluding to, selling when the stocks are coming down and then buying as they're going up, but because you're trying to catch up with everyone else. That doesn't work. And then the last piece is obviously just maintaining good financial habits. For me, financial habits is following rules. You know, one of the things that I often tell folks is I'm a rule-based trader. So honestly, anybody could do what I do if they were to stick to their strategy, you know? So I wake up every morning and I tell myself, hope is not an investment strategy, you know? So if you woke up in the morning and you bought Tesla because you hope it continues to go up, that's not an investment strategy. And a lot of individual investors will make decisions because they're hoping for something, right? Y'all remember last year, Hertz was going out of business. I had individual investors like, let's buy some Hertz stock. I hope it goes up. That's not investing. You see what I mean? That doesn't work. It's not an investment strategy. I tell folks, you don't have to be married to an investment decision. If you already have one wife, one husband, you don't have to be married to a decision you made in your portfolio. You can always decrease by a little bit. You can always increase by a little bit, right? So you don't have to take 100% of your savings and buy one thing, or take half of your savings and buy one thing. There's nothing wrong with taking a 2 or 3% position in something you find interesting. And if it's going well, you can always add a 0.5%, a 1% addition to that. It's not an all or nothing. Oh, I made this decision and it didn't work, so now I sell everything. Or, oh, I didn't make this decision, so now I'm going to put everything there. Better to reduce by 1 to the end as opposed to all or nothing. I also tell folks, don't make huge errors by continuing the compound series of small decisions. So if you bought Hertz and it went down, don't repeat that process by buying more Hertz in a way that's an over allocation to your portfolio. The way I would define an over allocation would be anything above 4 or 5% of your portfolio. I would say is an over allocation if you don't understand what you're investing in. If you do understand what you're investing in, I would say anything in the like 9 to 10% range would be a large allocation to that investment where you have high conviction. Does that make sense? In terms of your overall portfolio, for folks that might have real estate property or they're looking for some stream of income with rental properties, I would say 15 to 24% of your portfolio should be in illiquid investments. So again, if you have RSUs or ISOs and you have to wait several years before you can exercise those, or if you're taking a lump sum and then putting it into a down payment for an investment property, factor in your whole portfolio in terms of total assets, and that number, 15 to 24% of that should be in illiquid, well, should no more than 15 to 24% of that should be in illiquid investments where you couldn't make a phone call and have that money transferred back into your account. Anything more than that, and if there's some sort of correction, you might find yourself in a cash crunch where you're forced to liquidate positions and create cash, like liquidity events that are not in your best interest. Last 2 things I'll share. Everyone is a genius in a bull market, right? So it's easy if you hear your friends and they're Robinhood and all this, and they're like, oh, all this money I made last year. Everybody made money last year. So don't get caught up with what someone, he said, she said, all this money they made, because they made irresponsible gambles by taking 100% of their money and investing it in 1 or 2 companies. Also, investing is relative. That's the last thing I'll share. Let me rephrase that. Investing is not relative, it's absolute. So again, I don't need to compare how my portfolio is doing compared to Ekenna's, right? It's absolute. So if I started today, I don't have to say, oh, I wish I would have got it started investing 10 years ago. We hear that a lot. Someone's preparing for retirement, they're mid 40s, mid 50s. I wish I would have done this in my 30s or 20s. Look, it doesn't matter what happened yesterday. It doesn't matter what someone was doing earlier. What matters is that you're going to put in some money. And if at the end of your investment journey, you have more, you've made good investments, right? I mean, that's really what you're trying to do. It's a lot better than having your money sit in cash. And this is especially true for the women on this call. We do a lot of workshops around women in investing because, believe it or not, from a data standpoint, women are better investors than men as it pertains to total return. The problem is that women often have significantly more cash holdings than men because they are risk averse, right? So a lot of times we'll speak with a woman and she'll have 100% of her money in her savings account. We'll speak to a male, he'll have less money saved and 100%, and it'll be a bunch of risky stocks. So men have a lot more hubris when it comes around understanding risk. They're making impulsive decisions because they're taking on these risks. There's just more risk. We're more risk tolerant. I don't know how else you want to say it. And women, on the other hand, although they do end up with better performance over time, that's only if they are taking the step to invest that capital as opposed to leaving it in a checking account. 2 examples I'll share since we've got the Black BRG on. Bay Street manages the Alpha Phi Alphas venture fund. And something that's funny about this is the Alpha Phi Alphas have less money than the AKAs. The difference is the AKAs keep all of their money in cash, like literally all of it. They don't invest any money, right? The Alphas, on the other hand, they invest all of their money, right? So like, this isn't just a phenomenon of one individual. Like, this is how this works, like collectively across the system. And I was speaking with the Deltas last weekend. We were doing a workshop for them, and it was the same sort of phenomenon where we were trying to coach the women that were on that call that have these very large cash balances to understand that you have to invest your money, else inflation is going to eat you alive. And long term, if you've got a window, you don't have to worry about the ups and downs of the market. You can put a very simple strategy in place just by the S&P 500. If you want additional upside potential without too much risk of loss, you can add in 2025 upwards of 50% of the NASDAQ. QQQ would be the ticker symbol you want for that. And you can do those two things without worrying about on a day-to-day basis, am I going to lose some of the money that I have? Although it will fluctuate on a day-to-day basis, over time, if you've got time on your side, 5, 10, 15, 20, 25 years, you're not going to put yourself in the best interest if you're not allowing that money to work for you. Any questions there, comments? I've been talking a lot on the same slide. I kind of got carried away. If not, let's keep going. I want to share some statistics with y'all. Heck no, we can go to the next slide. African Americans are in a unique situation in that, and this is again is data driven. For those who've heard of John Rogers, he's the founder of Ariel Capital. Ariel manages $17 billion of mutual funds, his Black-owned firm. He's a mentor for folks like myself and Ekenna in this space. His grandfather owned a hotel in during the Black Wall Street burning. So that hotel today, had it not been burned down, would have been worth about $100 million. So to see this grandson come from that experience and build a $17 billion firm is something I think all of us should be proud of as a culture and as a people group. And something that John Rogers does is advocate for Black investors to understand through data where they are as of today. Part of what that is wage versus age. And what that means is that most African Americans think that I shouldn't start investing until I'm a certain age, as opposed to when they have a certain like income, like, you know, oh, I'm not going to invest until this point, versus the white counterpart, kind of regardless of where they are in that age cycle, the data shows that they start investing earlier. And as I touched on in the previous slide, time is the secret to this. You know, you need time to allow compound interest to benefit you. The next is lack of representation. For example, if you've never had a call with someone who looked like you around RSUs, ISOs, NSOs, then you probably were making decisions in the dark, or you never even knew that these were decisions that you should be making. You know, if you were running your own portfolio and you didn't have someone that you were comfortable working with, it's because there's a lack of representation in the investment space. There's $69 trillion in the US. 98.6% of that money is managed by white males. So that just gives you perspective. Only 1.3% of all of the money in the US is managed by people of color and women combined, right?
Question for you, William. I see in the chat. You said in your previous couple statements back, you said no more than 5% in any one investment. Did you mean individual stock?
Yeah, I'd be fine with that. Yeah, I wouldn't put more than 5 to 10% in an individual stock, especially if you haven't done the research that would lead to conviction, so that when it goes up and down, you write it out, right? So for most people, the best thing to do is to buy the S&P 500, and if you're younger or you're more risk tolerant, add to the S&P 500 some allocation of NASDAQ, because NASDAQ is a little more risk, a little more reward, and you don't have to get caught up in making an individual decision, right? There's literally not the fanciest thing in the world, right? But if you have time on your side, there's nothing wrong with just buying the S&P 500, whether it be in your brokerage account or in your 401k. You don't have to pick 4 or 5 different funds from there. You don't have to pick a target date and base it on your age. If you have an option where it says S&P 500, it's 100% appropriate to put 100% in that box and allocate 100% of your biweekly paycheck to the S&P 500, or 50% to the S&P, 50% to NASDAQ, or 50% to the S&P, 50% to like large cap technology funds. That's it's not fancy, but it'll make you well off if you allow compound interest to work for you and don't pull from that account on a year-to-year basis.
Thank you. Thank you, Nathan, for that question. Hopefully that answers it for you.
Last piece on this investment awareness. The survey that Ariel did, they found that 55% of Black Americans own stocks in their portfolio versus 71% of white Americans own stock. Now, the good thing about this is that 55% is actually up about 33% since 2020. And that's because, during COVID time, everyone was jumping into the stock market. I mean, it was just one of these scenarios where it didn't matter kind of what anyone's experience was. I think there was kind of this like fever around investing. And so a lot more people who were not participating in the market with all these easy access apps have started investing in the market, which is why we want to make sure that you're not opening these apps, taking on bad decisions like using margin or investing in these random meme stocks and things like this. Keep it simple. Don't get caught up in the noise in the crowd. And then from there, we can go to the next slide and talk about how, by sticking to a rule-based strategy, you can break this cycle and make sure that you're able to build wealth for yourself and for your family.
All right, thank you for that. All right, one thing that we always talk about as well, when we think about finance, we also think about very much kind of the emotions and the behavioral science behind that. And so one of the things that we did notice is that there's been a cycle and something that we're trying to break dearly, really trying hard. And what this cycle essentially is saying is the following. One, most people essentially, as we kind of saw the lack of guidance or lack of investment awareness, even for myself, my family did not talk about stocks, investments, and I'm the youngest first cousin, I'm the youngest child, and no one mentioned it, right? And so for myself, this is kind of the cycle that I've even noticed. And so often it kind of starts off with, your parents aren't really familiar with investments, so they're not going to teach you about investments. You start to grow up, you're going to be unfamiliar with it. And so what we'll see is that, generally when you're not familiar with something or you haven't been taught about it, you avoid it, right? You say, I don't know about that. I'm going to do something else that I do know. And so generally we see that, kind of children are somewhat a step behind on the financial awareness or kind of like financial utility of how best to put yourself in a better situation later on. And so that's something that we've also noticed as well. Building confidence, as it says, the issue does compound, right? So you're trying to learn something, but once again, the people that you normally would probably go to are either your family, where they're not telling you about it, or your friends, which they themselves aren't investment professionals, but just have somewhat of an understanding of it. And so then they're trying to kind of help bridge the gap. And so what we find is often African Americans, as Will said, they invest just much later in life than our white counterparts. And when you're trying to look at how do you grow your money the most, as Will also said, it's time. And so we think that the step 4, or really the most important thing, is once you do start to pick up some knowledge, you start to learn about the 401k, you start to learn about the S&P 500, or you learn about the different tax codes and kind of things that you can do there, share that knowledge. This kind of slide is very important, because when we often talk about why is there a lack of diversity in the workplace and why is there a lack of diversity in all these different positions, oftentimes, especially when dealing with finance, it's a lack, in my own opinion, a lack of knowledge around the industry, a lack of knowledge around the investments, which then lacks to a lack of participation. And so by sharing the knowledge, hopefully this changes it. And it's something that's very near and dear for myself. All right, so moving forward. All right, so we're gonna go over the quick steps. Step 1 is pay down what you owe. Quite frankly, the saying that we look at is it's better to de-invest prior to investing, aka if you have credit cards, things like that, where you're not necessarily going to be able to beat that interest rate year after year without taking on a lot of risk, we generally say, hey, pay that down and then invest the rest. Will, you got the next one?
Sure, and I want to take another break because we're coming up on 20 minutes, and I want to do Q&A. I honestly, Lockheed, y'all know what you're doing, you know. So I don't want to waste your time telling you things like, "Hey, you should pay your credit card." If I often like spending some time in my terminal and showing you how we make investment decisions. Can we do just a quick litmus test and see? I mean, what we've got left from here, we're going to go through credit, like how to get your credit score up. We're going to go through budgeting, and we're going to go through savings. If y'all have kind of been inundated with information like that, would you like for us to also spend some time just showing like, hey, look, if you're interested in making an investment and you're trying to decide between, for example, is Walmart a better investment than Costco? Like, how would you determine from an investment standpoint which of those companies is better for you to put your money? Or if you're trying to compare one fund to another so that when you're hearing information from the advisor, again, you can have a bit more data, a little more information so that you're not just blindly following someone's recommendation. How would y'all like to spend the rest of the time? Just so again, we can make sure that this is to everyone's advantage.
Again, feel free to put in the chat.
Yeah, I'm okay hearing both. Hearing about
yeah.
You know, I'm fine with that.
Yeah, I think people are liking this one-on-one. I'm seeing in the chat.
Yeah,
good
I'm
job
seeing
doesn't imply
both, too.
financial literacy. I want to hear both.
Okay.
You know, all right. So keep along with them. They definitely do want to hear. And I just want to put it quickly out there. This is the first of 4 installments. So we will be seeing more of them at least one per quarter. So just keep your, if you have any questions, even any follow-up, you can reach out to me, and you can, you know, or you can reach directly out to them, and we can, you know, hit some topics that people want to see.
Okay. Since this is our first one, and since everyone seems to be having a good time, Ekenna, what do you think about if I pull up pipes? You want to speak on technicals and explain like how a moving average works, and then I'll explain how financials work, and we'll just do like a quick run through. We'll compare 2 companies in the same industry, and we'll show this exercise of understanding and determining risk from a due diligence standpoint. And we can use part 2 of the session to dive more into some of the just general 101 topics that I have a feeling most everyone on this call is going to be aware of. You follow. What are your thoughts?
Do you know when our next talk is?
We typically, what do you want to do? Stefan, did you send?
The reason why I asked that is because I do think that having the fundamentals, mind you, I'm a little different, right? I'm a CFP. So I look at the financial planning as like the key to all success. And I'm biased there, so I'll be the first to say that. I'm kind of looking through the chats, you know, okay, that's something.
I'm on board with you, Ekenna. I think the fundamentals will get them going. And then that way, in the next ones, it'll make them a little more sense about the investment side. And like I said, we're seeing in there, you know, we do have quarterlies coming up, and so it's gonna be every 3 months. Just so about 3 months from today will be the next installment. But you know, it seems like people are very, very happy to get this. So maybe we'll change the schedule up a little bit. So
Stefan, maybe real quick. I think you know, me, you, and Lydia had discussed. I think the next one that we would like to do is going to be Black History Month. I thought that'd be a pretty fitting one. So we're looking at February-ish for the next one, if that works out.
Yep.
Okay.
Cool.
I mean, Will, I'll let you make the executive call. I'm biased, so I can't, you know.
Okay. But I think kind of you're right. I mean, we would be kind of rushing through if we were to pull up a terminal. And again, that'd be stuff that you've never seen before. I just really think it's important for folks to know how to measure risk and how to make investment decisions. But I agree. Let's keep with what we're doing. Let's go on. Let me pull back up. I want to see what slide we're on. I have a different screen pull up. Are you here? Okay, so we're talking about debt now. Now, debt kind of has a bad reputation because often we hear, oh, you shouldn't have debt. We're talking about that bad debt right now. There are some forms of good debt. We're not going to get into that on this call, But just know that all debt isn't bad debt. So for example, I'm going to share an example of good debt. Let's say again that we've got some folks that are interested in real estate. You know, if you've saved some money in your account, you're going to put down $50,000 on a down payment on a home. An individual is allowed to have up to 10 FHA loans in their name. Okay. What that means is that you can go out, you can buy an investment property, put your 50,000 down, and let's say that the home is $300,000. Let's say you're buying something, you know, in Huntsville, Alabama, where I'm from, right? And you've got your $50,000 in this property, and you fix it up, you're ready to rent it out. It would be a good form of debt in certain circumstances to refinance that property. It would be refinanced at an 80% loan to value, and you could pull back out that $50,000, and now you have what you would call a fully leveraged property, right? And again, if you're in the Bay Area, you can do the same thing. Say you buy a home that's $800,000. You put down $130,000, $150,000. You hold that home for a year and a half. You get it reappraised at $1 million. You can now do a cash out on that property, and you will be given a new loan that's 80% loan to value. Well, your home has appreciated by $200,000. That means your new loan would be $800,000. You would receive a check from the loan around $150,000, $200,000. That's about what you put in for your down payment. What has happened? Your monthly mortgage has increased by a couple $100 per month. Yes, but you're fully leveraged, meaning that now when you put a renter in there, if they're able to cover that new mortgage amount, you're making money on zero money that you put in. Does everybody know what's going on here? Much rather you have that sort of good debt. You put down a down payment, the home appreciates, you refinance, you take your down payment back out. Now you literally own a property with no down payment in it, and your renter is covering the monthly mortgage, so that you now have a property where you're making all that appreciation, all that upside in the future, and you don't have any of your personal money tied into it. That's leverage. That's how you would use debt in a positive way. What we see here, the bad debt, to avoid this, you want to make sure that you've got 6 to 9 months of income in savings before you get into investing. Okay. That's the big story here. You've heard it before. Practically speaking, why do you want to do that? Because you do have things that come up. My Ecobee this morning said, hey, something's wrong with your furnace. I have no idea how much that's going to cost, right? Things like that come up, and you want to make sure that you're not dipping into your investments to cover those expenses. Let's go to the next slide, Ekenna. Cool. Ekenna, you can talk about journaling here. You're on mute, bro.
I have not been able to make it through one seminar without having Will tell me that I'm on mute, and it's a personal thing. But anyways, all right, I'm just going to kind of go over some slides briefly. When we look at credit, everyone talks about an 800 credit score, but the reality is that 760, 740 range is really going to be the best thing for you to get kind of the best rate, right? 720 also is a big kind of cutoff where once you're at 720, you know, you're generally going to kind of get the best deal that the dealership or mortgage, whatever that looks like, is going to offer. Moving forward, I do think it helps to kind of understand what actually creates your credit score, and primarily it's these 6 things, right? Payment history, aka are you paying on time? Debt to total credit ratio, how much of your card are you using? And credit history, that's more of just how long have you had credit. Starting young, actually, in this case, does lead to a better result. And then also, you know, do you pay on time, and what percentage do you pay each time? The kind of amount that you want to look for, that credit companies look and say, hey, the total amount of credit available to you, take 30% of that, and that's actually going to give you probably your best bet at a high score. I know you would assume that 0% kind of credit usage would lead to the best score, but you'll actually lose points. I think it's kind of a backward system personally, but essentially what they're saying is, hey, you're not using it, so how do you know that you're using it responsibly? Once again, it's backwards. It's not our rule, but that's very much how they look at that. All right. Budget monthly. All right. So big thing for myself with every client that we do on the financial planning side is you have to know the budget. 95% of humans, not African Americans, not Caucasians, not Hispanic, just humans across the board are natural spenders, meaning that you're walking down the street, you find $100, or you get a raise and you have an extra $100 a week. We're going to find a way to spend that, meaning that really there's no amount that you can make that your mind won't try to find replacements of how to spend, AKA the lottery winner who loses it all, right? And so I always like to point that out. Make sure that you understand your budget really does allow you to be in a better position. I do journaling with a lot of my clients. Really all that means is that we have you write down every month, what type of recurring things do you have? How much are you going to be putting into the investments? And then understanding that, hey, if you create a bill, and I use the word bill specifically, that says Roth IRA for me, and start to really shape your mind to say this is important and a necessity. Just like your light bill, you don't pay that, your lights go off. Same thing, you don't pay your Roth IRA bill or your rollover bill, hey, you may not be able to retire when you want. So kind of just changing the mindset there definitely is what puts people in a pretty positive spot. I'm gonna move on. All right. Also from a mental aspect, we do want to understand the difference between emotional spending and thoughtful spending. Biggest difference, emotions are very much tied with money. In fact, if you rely purely on instinct and emotional, kind of thoughts, you're almost going to do the wrong thing with money most of the time. Just instinctually, it's just not what we're supposed to do. I'm not sure why that worked, but being thoughtful, so understanding why you're spending money versus like, hey, I'm bored, like let me feel something to do, really does separate, I would say, the person with a great trajectory from good, average, and below. Just being thoughtful, understanding what you're doing. Not saying let's not have fun, but making sure that we're doing in a strategic manner. All right. Abby's, we've mentioned a few times in this conversation, hey, we want to grow the savings, right? And how do you grow your savings? I mean, one, you can actually, just kind of create that bill that we talked about. And then moving forward, don't leave money on the table. There's definitely ways to essentially add more money to your net. So you look at what you're spending versus your take home. Hopefully there's a net amount. Hopefully we can add some money to that net. And great ways to do that: change your withholding, make sure you're getting the most out of your taxes, reduce interest rates, any type of credit card, see if there's a way to reduce that. You'd be shocked what happens if you call Chase and just kind of ask questions. They're generally pretty helpful for that. Refinance your car loan, refinance your mortgage. Currently mortgages are about 3 to 4%, depending on how large your house. And so if you're above that, it may be a good time to reconsider a refinance. Wish we would have had that conversation with this group maybe a couple months ago, because it's crept up a little bit. But as a whole, that's kind of where we are there. Consolidate student loans. Usually you'll see 5 to 7% kind of on the student loans from the government. A lot of private places, if you have that 720, 760 credit score, they're going to be south of 5%. So, 2, 3, 4%, which would save you more money. And then maximize your pre-tax saving. I would say that's a little dated. I'm a big fan of Roths currently. Get rid of car or trade down. I need a car, so I somewhat say that, but trading down, especially, I have clients that have a couple of cars. If you only need one, or if you're in a family where really you can get by with one, great way to kind of do that. Increase your earnings. Who doesn't want to raise? And then sell some of your material goods. Things do have value, right? Understand, what is it that you're doing with it? If you're not really doing a lot with it, may be a good time to kind of push that forward. All right. Any questions here? Sorry, we're almost wrapping up here. All right. Any questions?
I see one in the chat. Or is that so? Emergency funds, about 2 to 6 months wage, can take some time. Do you recommend investing zero or small amounts until emergency funds are saved?
Yeah, great question. I generally would say that emergency fund should be 3 to 6 months. If you're someone who has a stable job and someone else that you're working with that could kind of take some of the load, if you were to unfortunately lose your job, 3 months I think is actually appropriate. If you're someone who lives on your own and or have a dependent or a mortgage, 6 months is where we want to be of your overall spending. I generally say, you want to get to the point where the emergency fund is within reach. Now, if you're someone that says, hey, I'm spending $5,000 a month, it may take you a little while to get to 15,000. And so I would say there's a point where you're contributing a little bit to both, but the initial starting point is going to be focused on the emergency fund. Okay, is it plan? Correct. I get it. Yeah. Exiting the market or trying to time the market. Great point, Christopher. Definitely leads to, I would say, kind of bad results more times than not. If you're trading versus just staying in, you'll see that those people trading actually end up with lower returns, although that they seek, maybe higher upside at times. All right. And then kind of one of the last slides, maintain good financial habits. Okay, I'll dive into that, Willie. Once you kind of get going, stay with it, right? So I've personally have journaled for the last 2.5 years, 3 years almost, of every month I put into a note, and I know exactly how much I'm spending outside of food and entertainment, or really any not emergency trips, but last minute trips. So I would say definitely start to get that going. Once you have it, hey, continue moving, because once you start, I think it's 14 days it takes to become a habit. And so going there. And then, yes, if you do have any further questions, we're going to open it up now. I'm going to answer Willie's question. And we do want to kind of schedule, if you do want to schedule, this is a direct link to my calendar. Here's William's phone number, and here's my phone number, as well as our emails. And to your question, emergency fund or pay off debt first. Generally, you're going to want to pay off debt first. Although it's good to have an emergency fund, the debt is accruing interest, meaning that, in a current credit card situation for most Americans, 22% is kind of the average. If you're north of that, you may want to look at that. So let's say you spend $100. If you don't pay that off over a course of a year, that $100 is now $122 versus the emergency fund. Hey, you put the 100 in, you're sitting it, you actually are doing yourself kind of a disfavor there. So yeah, great question. Pay off debt first. What other questions? We have 5 minutes. Please ignore my friend with the Roll Tide comment. We're SEC fans over here. I'm an LSU fan. Unfortunately, my business partner is an Alabama fan. This is a week-to-week conversation that we have, but still SEC, so it's in the family. But yeah, we have 5 minutes. Really, any other questions?
Yeah, I have a quick question in regards to trying to buy a investment property.
Yep.
Considering in the Bay Area, what is a more economical way of trying to purchase that investment? I'm right in line with what you were saying about how to leverage it, but trying to get there and make that purchase is kind of like where I'm curious about. Is it realistic? Can it be done?
I would say, depending on your situation, with the right planning, really, most things can be done. And I tell people, because where do you live? Or where would you be looking at for the investment property?
Well, ideally, I'm in San Jose. I would love to buy one in San Jose, but I've been thinking about the Sacramento, because that area is going to be probably more affordable to get me started.
Yeah, and that was actually exactly what I was going to say. Sometimes you really, especially investment property, because they expect someone a little more to come down to make sure that the debt to income doesn't get thrown off in the purchase. I would say either look for unique loan situations that you can say, hey, here's the current amount of rent that it is, trying to find a mortgage person. They're out there that says, hey, if you can prove that the rent can cover the mortgage, they can give you some favorable rates without as much of a down payment. That's one option. Second option, if your zip code that you're currently looking in is something where you're like, hey, maybe I can't afford this, look at a different zip code. There's many zip codes across the US, Arizona, Michigan, Alabama, to name a few of some really stable economies where your money would go further, less of a down payment. And the net amount of, hey, you're spending $1,000 per month on the house, you're receiving $1,400, $1,500. actually may be somewhat similar, just depending on where you are, you know. And so glad to talk to you about that one-on-one. If you want to schedule with myself or Will actually does the investment property thing. So he may be a little bit better on that side. I like to keep the money in the stock market personally. But yes, there's that. And then we did have a question from Eric. What options do you suggest IRA distributions at 60? Oh, Will, sorry. Did you want to comment on that? Sorry, brother.
I was just going to say, make sure that you have appropriate expectations. So for those who don't have rental property, the average net income that real estate investors make is $250 a month. And that might surprise a lot of folks on this call. You might think, oh, if I had a tenant, I'd make a lot more than an extra $250 a month, right? Also in the Bay Area, kind of as you were alluding to, the prices are such that covering the total mortgage is not necessarily the play for the investors. Typically the upside appreciation of the property. If you were to buy something in Sacramento or the like Central Valley or even like the LA area, rental terms are much more favorable. So likelihood of making that $250 a month is reasonable. For example, we rent out a place in Los Altos and the rent doesn't cover the mortgage, but the home appreciates much faster than in other areas in the US. And the Los Altos market is a market that I understand. So kind of back to making investments with conviction. Don't invest in areas that you don't understand. Just because you can afford a home in Texas instead of San Jose doesn't mean that you should start buying a bunch of property in Texas, because that's not an area that you understand. You know, stick with things that make sense so that as you're dealing with finding the renters, working with the property management companies, et cetera, you have a sense of what's going on. We had a question from Eric before we
real quick before we move into that one. I just wanted to give everybody a break or release because we're coming right up on time. And we'll if you want to stay on to kind of ask any more questions, I'll be okay with that. Just so thank everybody for coming, and I'll try to get this out to you. I'm going to stop the recording here.